here are the top asset classes that people invest in. And so if you're looking to build up a portfolio, save money for the future, which is really what we're doing here, yeah, crypto is great. We love crypto, but if it's not giving us the returns, then it's not investable, right? At the end of the day, supporting a crypto like a football team or anything like that it's an embarrassment, right? What you're looking to do is take advantage of assets that provide value for you. Save your money over time, make returns. Doesn't matter what it is. As long as they do that, we can put them in a portfolio. And anyone can choose the amount of risk that they take. These are the top assets that are investable asset classes. I think Bitcoin is, many people don't. But Bitcoin at the top, you can see the annualized return outperforms everything else. You get these massive drawdowns of 70, 60%. Yet, the annualized return is almost 10 times all of the other asset classes. It's much newer, and therefore you get the volatility. Of course, we can put any portfolio together we want, right? So how much risk do you want to take? You can put together a portfolio of, well, NASDAQ, technology is doing really well. US growth is doing really well. US large caps, right? So it seems to me like US large caps will be the S&P 500. So US tech and businesses tend to outperform. They do really well. You're getting around 10 to 15% a year returns for that. That's going to protect you from currency debasement, which is why those indexes are great. Now, Bitcoin, with so much outperformance and volatility, maybe people would want to add a certain percentage to their portfolio. So, a lot of people hate Bitcoin, hate crypto. Jamie Dimon says it's garbage, it's worthless and everything. What type of circus clown says that the best performing asset over 15 years, 10x anything else, shouldn't be in a portfolio? Right? If you're an asset manager, either a professional one or doing it yourself, your job is to put together a portfolio that gives you a good amount of return. This one is, without a doubt, the best performing asset. If you are not including that in your portfolio, you are a clown. That is a fact. That's not an opinion. This is factual stuff. This isn't a 1 year thing. It's not a joke, right? At what point after 15 years do you have to just admit that this thing doesn't seem to be disappearing? Now, you may say, not too sure, pretty risky, don't understand it yet. That's fine. So you can make a portfolio of 1% allocation to the best performing asset in the world. Maybe 2 or 3, maybe 0.5%. You can take that. But to ignore asset classes that are growing is obviously idiotic. However, these assets just are used to give you something that you want. So you can see REITs, this is property, about 7-8%, good return, right? You can see bonds down here below my head. They're pretty much like 2, 3, 4%. Garbage, right? But if you're 70 years old and you know that you need, 15, 20 years or whatever it is, then maybe that's all you need because you've got your savings. You can actually switch from the volatility into the less volatile stuff. That's what you need. It's not about calling the market or being right or anything. It's just about allocating the amount of risk that you want to asset classes that grow a certain amount each year. So over this very, very long time, these are the averaged annualized amounts. So what you can do is just pause the video or screenshot this just to see these. These are what's going to happen. And so you can take as much or as little risk as you want in these things. Now remember that the inflation rate or the currency debasement rate is around 7%. Seeing that inflation, currency debasement, we know that the cost of capital is around 7% a year. So anything that's under that, you're actually losing money to the rise in prices of goods and services. Anything around that, you're saving your money. Anything more than that, you're actually growing at or above the cost of capital. Everyone can make their own decisions, but asset classes need to give you a return, and they're volatile, it's fine, but obviously they need to give you that return as well. If you are investing over longer time periods, you don't need to call the market, you don't need to call prices, you don't need to be correct in any way. You just need to make a decision about what assets that that you want to get exposure to, and let the price gains play out. Assets will outperform dollars. You will make returns. You don't need to do anything other than choose where you want to allocate, get your percentages, and then just wait. The big thing as well is that it's not about trading with small amounts. It's about making the biggest portfolio that you can and having something reliable. If you save up for 30 years and you get a portfolio of $1 million, a 10% move per year, that's 100 grand in your bank account each year on that $1 million portfolio for doing nothing. You haven't even woken up and you're getting those returns. And that can pay for the rest of your life, right? If you're trying to trade short term with smaller amounts, you're trying to be tactical, you're just kind of one day away from losing, right? And it's not reliable. So time in the market is really the thing, and being able to invest confidently in the assets. We've all seen those assets that go up, altcoins, right? You get 10x in the altcoin, and we want it quick this cycle. I get that, like I totally understand that. And we can have our bag for that, our risk bag, right, in the percentage. But the bulk has to be large, reliable assets that you can put big money in. Because if you can have a bigger portfolio, smaller percentage gains that are more reliable, that's the sweet spot. How many people approach the market as a dollar cost averaging strategy? Dollar cost averaging simply means buying with the same amount at set intervals. The reason why most of us do this is because we earn wages. Some of the wages goes into our retirement account. Some of the wages goes into whatever we want. So that's how it's done. So every month you get paid, some of it goes into your savings or whatever. After an amount of time, like if you plan on being alive for the next 20 years, why not have a plan for that? And suddenly 20 years goes by, you've got a big portfolio, and you're in a really good position. But if you're constantly speculating, trying to trade, it's more difficult. So dollar cost averaging, put money in over time, and then you just get an average price of whatever this is. Remember, you're exposing yourself to assets with growth, and that's what's going to get the performance for you, not timing too much. DCA, or dollar cost average, buying every week the same amount, it's not a better strategy than the other thing, which is lump sum. Lump sum, you got 50k, put it all in. Neither is good or bad, because you don't know where the price is going to be. So you could dollar cost average and actually get a worse price, especially on assets that are growing like Bitcoin. If you're buying and dollar cost averaging as the price moves up, you're getting worse prices all the time. If you could put all of that money earlier, that would have been better. Most people that don't have this choice, we earn wages, we put a bit away, dollar cost average, and so buying amounts each week. It's access to the assets with growth that give us the performance. I cannot give investment advice, and each person is going to have to think about what percentage can they do with their income. This is just a guide. So you have income and you have your expenditure. You have assets and you have your liabilities, right? So we have an income each month, and let's see where are our liabilities, where's our spending, and then what can we put towards assets, right? So money doesn't exist, you only have assets and liabilities. You've exchanged your labor for this money that's just numbers. Now we have to allocate those numbers in the way that benefits us. So you get your income, whatever that may be. You pay rent, so that's just out. You pay a mortgage, 5% that you're paying on your mortgage. Maybe your mortgage is 5%, 30 year, or something like that. A mortgage is basically forced savings in property. You're investing in real estate, right? A mortgage is, I want to buy this house, I can't afford the whole thing, so I'll pay for it over 30 years. It's like a savings plan for property. And so if you're living somewhere and you think you're going to live somewhere for a period in time, certainly a mortgage or investing and saving in that property may be a good idea. We know that REITs or real estate investment trusts, these are basically broad investments in property. They go up around 7%. So they go up in line with currency debasement. So as long as you are paying for the property with an interest rate that is lower than the rate of currency debasement, you're all good. If you're paying more in interest than the currency debasement, it's not, not a great leverage play there. But if you live somewhere, maybe mortgage is good to save in time. You're dollar cost averaging into real estate. That's what you're doing. You have car payments, right? So that has to be paid. 4% you're paying for the car payments. Student loans, you're paying an amount there. Used to be free in the UK, but not anymore. That's where I got this from. The amount that students are being paid now. Credit card, you got some money on there, you're paying 20%. Right, so not great. Then you have insurance that you're paying each month. And then your other monthly costs, food and entertainment or whatever. After all of that, you have excess capital that you can put into investments. Of that capital, you have a pie chart, or whatever, a percentage in each, right? Whatever you want to do. Everyone's different. You need some cash on hand for a rainy day fund if you get injured or lose your job or whatever, you need some money there, right, as a backup. You need that safety, right? Then you need maybe 6 to 12 months of spending cash for a rainy day. Now again, that could be 2 months, 3 months, 8 months, up to the individual. If you have an amount of cash that is your rainy day fund, and you know it's there for drawing in payments or whatever, you would probably put that in a money market fund. So a money market fund is a short-term investment that the money market fund, these are run by the big firms like Vanguard or VanEck, whatever. They invest in government debt, short-dated government debt, right? And so you're going to get paid back. It's a small yield, right? Maybe 2-3% or something like that. Money market fund, you can trade them easily. So buy them, sell them. You might have a savings account that basically does it for you, whatever it is. Money market fund for that cash that you need. Because if you don't need it immediately, if it's not like your day-to-day cash on hand, then you should be earning some yield on it. Because otherwise it's just getting debased. And the money market funds are very liquid, fungible investments. You buy and sell, but you're getting the yield. There are other ways to do that. For example, with crypto, you can use stable coins and then you can use DeFi. And you can lend out on DeFi and get yield like that. So some people do that for their money market fund if they choose. Whichever one is easiest for you, maybe cash in the bank's better. Then you have your home equity, which is your assets, and that is being gained each month. So if you're paying this off, each month you're paying some of the house back, you're getting equity in your house. That becomes an asset now that you can draw on. So if you've paid 2-3 years, you have equity in your house now, and that's actually something that you can use. You can leverage it, right? You can change that around. So that's actually an asset that comes into you every month. Then from here, this is your risk asset portfolio, right? So again, everyone can choose the amount they want, but we've seen all of the performance of what's happening here. So again, these are risk assets that you can choose. But you can make any percentage portfolio that you want, right? So have a pie and say S&P 500, that's, we know that's strong and reliable as an index. NASDAQ outperforms a little bit, but it's a bit more volatile because it's technology. Bitcoin's super volatile, but it's a great risk-adjusted investment. And then I've got my altcoins here and some other bets that I just want to use, and I think they're great networks. Then you've got mid-caps here, right? Like mid-cap companies, you buy an index for that as well. Whatever it is, it's like 50, right? 25 for this, split this up, whatever you want to do. And as long as you're comfortable with the risk and the volatility of those, so you know what they draw down, you know the return that you should be getting each year, and that's up to the individual to choose, but it's as simple as that. All of the emotion, market timing, market expectations taken out of it. Simple, straightforward way of trying to save the value of your output over time. To end this section as well, I want to quickly touch on CAGR, or compound annual growth rate. This is the annual growth rate of the assets that you're investing in. So we saw this, which is annualized figures. So that can be, what is expected to grow. Now, what this is going to do is, index these early amounts where Bitcoin was growing thousands of percent in a year or so, and that's just not going to happen, right? So what we usually do is a 4-year CAGR, or you can do anything you want, but 4-year CAGR. So that means over the last 4 years, with volatility in between, what was the growth rate around about? Well, Bitcoin's CAGR, as of right now, so this is black Bitcoin price, orange compound annual growth rate, is 60%, 55%. So that's the compound annual growth. You'll see as the price goes up, the compound annual growth goes up. As the price goes down, the CAGR goes down. You can see that also over time as Bitcoin matures, its annual growth as an average of 4 years tends to decrease. It's around 55% now. But let's take Bitcoin if it was a 20% annual growth rate. So you know that if you could hold the thing for like 5 years or, an amount of time, it's going to give you maybe 20% a year. Then you can start making decisions about the other liabilities that you have. For example, if you've got a 6% student loan, should you use your money to pay off the loan at 6.25%? Or should you keep the loan, pay the interest, whatever, and put the money in Bitcoin? Bitcoin is growing at 20% CAGR, and so you could do the calculation there that actually it's better to keep the loan because the money that you've got to pay it off in an asset that's growing faster than the rate of the loan is actually going to pay off the loan at a faster rate than you paying off the student loan, because the interest is 6 versus 20% CAGR for BTC. If you've got these are also low, but if you've got a credit card, maybe that you should pay that off first, right? So it's about risk here. Bitcoin could have a 20% CAGR. It could also go to zero tomorrow. The network could blow up. If you pay off your credit card, you're paying off that loan and you're saving 20% on the balance of that loan each year, and you have 100% certainty that that will happen. So if you've got high interest liabilities, maybe make a decision, do you want to pay them off? You have 100% chance of getting a better outcome by paying that off. This may seem good, but there's volatility. There's no volatility. So that's why I always come back to it's about you and your circumstances and what makes you feel okay. Because having debt is a burden, and maybe Bitcoin can outperform that, but maybe that's not where you want to be as an individual because it stresses you out and stuff. So it's about the individual, who you are, what you want to decide, and what's best for you.